Now, what do we mean by a capital market? Before I attempt to answer that question, I want you to take a look at this picture. What do you think this is? Well, of course, this is a vegetable market, a market where you go and buy vegetables, right? Well, very simple. Yes, of course. But then what is this? Well, this is a share market, a place where you buy and sell shares. But then what is the difference between this and this? Well, apart from the fact that in one place you are buying rudimentary stuff, buying and selling rudimentary stuff like vegetables, and in another case where you are buying a bit more complex things called shares of a company, there is not much difference between these two because both of them are markets. So, what do we mean by a market? Well, a market actually is an actual or virtual place where forces of demand and supply operate and where buyers and sellers interact directly or through intermediaries to trade goods, services, or contracts or instruments for money or barter. What does this mean? Well, it means that a market is a place basically where buyers and sellers will interact to buy and sell something. The marketplace could be actual, it could be a physical place like a vegetable market, or it could be virtual. That means it does not exist physically but is a collection of computers over a network which creates the market. Okay, it is a place where the buyers and sellers interact to trade some goods or service or contracts or instruments for money or for something else. It could be a barter market as well, where you provide a commodity in exchange for another commodity. Okay, but the key thing about any market is that there is a buyer, there is a seller, and the forces of demand and supply operate in that market. Okay, so in simple terms, a market is a platform which enables buyers and sellers to interact and transact. Okay, it could be directly, they might interact with themselves directly. For example, when you go to a website like olx.com and quicker.com, it's a marketplace which is direct, which is in a way direct because you're directly trying to contact the buyer or the seller. Okay, but a market like the stock market, if you are going to buy and share some shares in a stock market, you will have to do it through a member of a stock exchange, and the member is a broker. So you have to buy shares via an intermediary who is the member or the broker of the stock market. Okay. So what is a capital market? Well, a capital market is just like any other market, but in this case, what is being traded between the buyer and the seller is capital. Okay, or in simple words, money. Well, why do we have something like a capital market? Well, because at the core of any economy uh, is capital, right? What I mean by this? Well, any business which is producing a goods or a service will not be able to produce its goods or service without capital. It will not be able to pay its employees, it will not be able to pay its rent. So capital is very important for businesses. For households like you need capital for your day-to-day activities to buy the necessities of life. Okay, for governments, capital is very important because a government cannot build roads and bridges without capital. They cannot, put money into welfare activities without capital. So capital is at the core of any economy. So it is but obvious that a market for capital is crucial for any economy. So what is the structure of a capital market? Well, just like any market, a capital market has buyers, it has intermediaries, and it has sellers. Who are the buyers in the capital market? Well, one example of a buyer in a capital market is entrepreneur who is in need of a loan. So he takes a loan from a bank to, say, set up a factory. Well, in this case, the entrepreneur is the buyer of the capital. The bank is the intermediary. It is not the seller of the capital. Why? Because the money which the bank is lending out is something that the bank got via deposits from investors or depositors. So the sellers of capital in this case are the depositors, the bank is the intermediary, and the entrepreneur who is going to set up a factory is the buyer of the capital. Okay. Other forms of buyers in a capital market. Well, companies which sell shares in the market and raise capital are also buyers of the capital. In this case, the investors who buy the shares of those companies are the sellers of the capital, and the intermediary is the exchange or the investment bankers which facilitate this process of raising capital via issuing shares of a company. They are the intermediaries in this process. Uh, Other examples of capital markets, buyers in the capital market. Well, when an entrepreneur or any company or a business tries to raise money by issuing new loans directly to investors, not going to the banks, but directly going to the investors to raise new capital, is also a form of capital market activity. In this case, the buyers of the capital are again the company or the business or the entrepreneurs, and the seller are the investors who buy uh, the loan of that particular company or buy the bonds of that particular company. Okay. Similarly, governments are also buyers in a capital market. They raise capital uh, primarily via debt to finance their activities. Uh, so in this entire market structure, as you can see in your screen, you do need a set of umpires, so to say, who will provide the guidelines and will ensure that there are no loopholes or any illegalities in the process. Who are these umpires or regulators, as we call them? Well, SEBI, which is the Stock Exchange Board of India, that's one major regulator of Indian stock markets or stock exchanges. Then there is the Reserve Bank of India, India's central bank. They're also a very important player in framing policies which provide guidelines of how the capital market in India should work. Then there is the FMC, the Forward Market Commission, which is a regulator for commodity markets mostly. And then you have the various government ministries, which are also the policy framers who set the rules and the regulatory policies for capital markets. Well, there are basically two types of capital markets. One is equity capital markets or stock markets, which you all probably have heard. This is by far the more popular capital market. But there is the other capital market, which is the debt or bonds. Well, equity capital markets is where the owners of the businesses, part with their ownership of the company. That is, they sell the ownership of the company to investors, and investors buy a share of the ownership of the company, and hence the word share. In a debt capital market, the company which wants to raise capital, which wants to raise money, does not actually sell ownership of the company, but what it does, it raises loans directly from the investors, promising to pay back the capital that they have taken along with a certain amount of interest. Okay, so this is basically a type of a loan, but in this case the loan has not been taken from banks, but it has been taken directly from investors who buy the debt of that particular company. So that is a debt capital market. So these are the two broad types of capital markets: equity capital markets, where ownership of the companies are sold to raise capital, and debt capital markets, where companies borrow money directly from investors to raise capital. Okay.